Good day, everyone. I welcome you to this presentation. Now, let's talk about how to calculate the capital charge for operational risk, under Basel 2 and Basel 3. This is one topic that is proving very difficult for so many operational risk professionals. So I'll try as much as possible to try to make it, keep it very simple. Now, we want to recollect that if you want to measure operational risk, there are certain parameters that must be in place. These are, you need internal loss data, external loss data, where there is a set of truncated, set of data in a distribution. So you need to bring in information from the external environment, that is external loss data, maybe assessing of the operational risk exchange, or you can also create scenarios, to be able to generate your frequency and severity distribution, which will then help you to generate the loss distribution. But before we come to that, let's just understand that under Basel 2, there are three approaches for calculating, the capital charge for operational risk. The first is known as the basic indicator approach, where you take the average over the last 3 years of gross income, and then you find the average, and then you multiply by 15%. That gives you the capital charge. But for under the standardized approach, it's a little bit more complicated, where you now have 8 business lines, and then for each business line, there are risk factors that are attached and defined between 12% and 18%, according to the Basel Committee on Banking Supervision. So you get the gross income for each of the 8 business lines for 3 years, and then you try to also do the same averaging for each business line and multiply by the risk factors, and then you then find the total that gives you the capital charge using the standardized approach. But the advanced measurement approach, which is the third approach, is a little bit more complicated. In this particular approach, you need to be able to generate your frequency distribution, your severity distribution, and then using Monte Carlo simulation technique, as well as the Latin hypercube, because the Monte Carlo simulation technique is said to be blind. So using the Latin hypercube, you are able to generate the loss distribution, the aggregate loss distribution, which can then, from there, you then proceed to calculate your capital charge using the advanced measurement approach. Now, what has happened under Basel 3, the Basel Committee has collapsed the 3 approaches into one, which is referred to as the standardized measurement approach. So all the 3 approaches have been collapsed into one. But this time, what happens under Basel 3 is that you now need to calculate, estimate, for 2 main parameters. One, the first parameter is called the business indicator parameter, and then the second, again, the loss data. Now, if you take a look at the business indicator, which is called the business indicator, component, you will see that they have meshed. They have brought in the both the first and the second approach under Basel 2. That is the basic indicator approach, and then of course the standardized approach. Those 2 approaches are based on income, the gross income. So that has been collapsed into one, which you now refer to as the business indicator component. Now, the second parameter is the loss multiplier, which is more like the AMA, the advanced measurement approach, aspect, which has now which is now described here as the loss multiplier. So the challenge, therefore, is if you are to calculate the capital charge for operational risk, then you need to calculate the business indicator component, and then of course determine also the loss multiplier. Then you multiply both, and then you get the capital charge for operational risk. Very quickly, what happens is that for the business indicator approach, the business lines here this time, they are not those typical, they are not those 8 business lines. The business lines here are now ILD, SC, and FC. ILD stands for interest, lease, and dividends component. Then SC stands for services component, and then FC stands for the financial component. So what then happens? You need to calculate, the gross income, for each of these lines, and then of course you sum at the end of it all. Okay, you sum at the end of it all. The calculation is a bit complex, but if you check very well here, it's very easy, to calculate. But the message is calculate the business indicator component. Now, once you're able to sum, get the result for ILD, SC, and FC, then you also need to go further. So whatever total that you have obtained, so let's say your calculation, the sum gives you, let's say 40 billion. You then have to, allocate that 40 billion as shown below. The first 1 billion euro, you have to multiply it by the 12% coefficient. And then the next 29 billion, you multiply by 15%, coefficient. And then, of course, the remainder, anything that is above 30 billion, you multiply by 18%, the 18% coefficient. So between 12, 15, and 18, those are the risk parameters, which is very similar to what you have under the Basel II, which is also between 12% and 18%. So, but everything has been collapsed into 3 buckets instead of the 8 buckets under Basel II. So once you now sum the total here, you sum the total after multiplication by the risk parameters, then you now need to go further to calculate the loss multiplier. Now, the loss multiplier is calculated, which based on bank specific historical observed operational loss data over a 10-year period. Now, where the loss multiplier is the same thing, equals the business indicator component, then of course the loss multiplier takes the value of 1. So the loss multiplier is based on 10-year historical loss data of the bank. So if you look at this table here, it's very clear that if, for instance, the loss component is 1.74 billion euro, and also the business indicator component is also 1.74, you find that the value of the loss component becomes 1. You can see all through here. So where the loss component is the same thing as the business indicator component, then the loss component gets the value of 1. So the message really, what we're trying to say here is that for you to calculate the capital charge for operational risk under Basel III, all you need to do is to calculate a value for the business indicator component, as well as calculate the value for the loss multiplier, and then you multiply both. Well, the result you are going to get is going to be your capital charge for operational risk. I hope that this explains in a very simple way how to calculate the capital charge for operational risk, both under Basel II and Basel III. Thank you very much for your kind attention. Thank you.